Good day, everyone. Welcome to this new episode on Market Perspectives. We have with us today Dr. Joseph Thomas, Head of Research, Emkay Wealth Management. Dr. Joseph, thank you for being with us.
Thank you.
Few questions for you. What is your outlook on crude? The prices seem to be consolidating fairly slowly.
Yeah, the last 2-3 months, the crude prices have been in a range of $70 US dollars to around $80 US dollars. There are two factors at work here. One is the supply side factors. On the supply side, OPEC Plus have been cutting the output and restricting the supply whenever crude prices touched levels like $72 per barrel. So that supply restriction or output restriction has been a factor which has been supporting crude prices. The second factor on the demand side is that there has been economic recovery in China in the sense that they have come out of the COVID, but the rate of economic growth is still quite low. So there was initially an expectation that once China comes out of the COVID and probably as the economy recovers, there could be renewed demand for more fuel. But because of the low rate of economic growth at this point of time, which is sub 5% at present, the Chinese demand may not be as good as what it would have been otherwise. But there is a different view on this. A number of analysts feel that yes, Chinese economic growth is slightly sluggish, but they could come back very fast. There are also reports about the US government's official energy agency, going in to buy more fuel, actually to replenish the stocks of their strategic petroleum reserves, which is something which they maintain to meet any extraordinary demands for fuel and also to keep the oil prices in check in the international markets. So these are some of the factors on the demand side and supply side influencing crude prices. Now, one factor could lead to a rise in crude oil prices, and that factor is a likely depreciation of the US dollar. Once the rate hike cycle comes to a complete halt, it is probable that the US dollar could start depreciating gradually, in which case, crude being a product which is priced in US dollars could start depreciating, in which case oil prices could move up. Our view is that for the immediate term, that must in the next 1 or 2 months or maybe max 3 months, a broad range for crude would be something like $70 to $80 per barrel.
And how long do you think the crude prices will sustain these current levels?
I think we need to wait for the next 2 to 3 months. Beyond 3 months, probably more dynamic factors like demand from China, demand from India, the dynamics of OPEC plus pricing of oil, and the US interest rate policy. All these things will gradually undergo some changes, but that will be most probably beyond a quarter from now. That's about 3 months from now. So we need to take a relook at the factors and the things at that point of time, how it evolves and how it's going to impact crude prices.
In your interaction with Mint earlier on, Dr. Joseph, you had mentioned gold as an attractive proposition for the new investors. So is the shine still on, or are we looking at a flat phase in the near future?
I think gold will be fairly well supported. Gold prices have actually come down. It touched $2030 and it is now at around $1940 in the international markets. Now it moved up against the background of uncertainties in the global economy because there has been an expectation, and it still continues to be a reality, that there could be sluggishness in economic growth in all the major economies of the world. It has already set in Germany, it's seen in China. In India also, we have forecast a lower rate of economic growth from 7.20% to around 6 to 6.5%. So there is a sluggishness in the rate of economic growth, and there has been high inflation, global economic uncertainties, all these factors have favored higher gold prices in the last 1 year, 1.5 years. Now, which is that one factor that could influence the future course of gold prices? That factor is the trajectory of US interest rates. The projection is that if by Fed's official stance, there could be another two hikes in US interest rates to the order of 25 basis points each. So we believe that once, if US interest rates continue to rise, then gold will gradually come down. But that probability is much less today because the US monetary policy stance has moderated. They announced a pause in the rate hikes in the last policy, but they have cautioned that based on new data that's available, there could be another two hikes before the end of this year. So once the US rate hikes come to a halt, come to a stop, and if US dollar starts gradually depreciating, then gold could gain immensely from that. Therefore, we feel that gold is probably basing itself at the current levels or maybe a little lower. Last time we had seen it basing at around 1780 and 1830 levels, from where it bounced back and it moved up. So we believe that even at worst, it could be basing itself again towards those levels max. And from those levels, it could move higher. That's our view on gold at this point of time. And on the opportunities to invest in gold, the best opportunity that one could be looking at is the sovereign gold bond, the SGBs. For those who would like to invest 5 to 10% of their portfolio for a longer term call on gold, could get into sovereign gold bonds because it gives you an extra coupon of 2.5% in addition to a potential price gain on maturity. That's after 8 years. So that's a very good call. And those who would like to invest maybe for an year or two or shorter time periods could look at gold funds and gold ETFs. That's our view on gold.
Thank you. On a scale of 1 to 10, how would you rate how the Fed and the RBI have tackled inflation and interest rates? If you can elaborate.
Yep. At the very face of it, they have tackled it extremely well. They have been hiking rates in most appropriate doses, and inflation has moderated now, which means that they have been quite successful in tackling inflation. Now, they have also positioned themselves in such a way that after a pause, two pauses in India and one in the US, they have reached a point where they need to further modify or moderate the policy. Now, if you look at the policy stance in India or in the US, the central banks have cautioned the markets that do not think that this pause is a complete halt to interest rate hikes. They have said that data driven, if required by incoming data later in the month or maybe after a month or two, if it requires further hike in rates, it will be there. So do not be under the impression that a pause means no future rate hikes. So they have sent the correct message to the community of the market people and to the investors. They have given that message. A second thing which they have done is that we believe that what is important when it comes to inflation control and interest rate hikes is striking the most optimum trade-off between inflation control and economic growth. Because you are not expected to carry inflation control growth or the price stability objective beyond a certain point where it would start hurting the real economy. So if they have stopped the hikes at this point of time, or I would say paused the rate hikes at this point of time, it looks like they have come closer to the optimum trade-off between price stability objective and economic growth objective, especially in the light of the fact that the hike has been done many times over a period of last 1 year or more than a year. Inflation has moderated, and it looks like if you hike rates further, it would hurt the rate of economic growth. So it is an extremely commendable job that they have done, especially in identifying that optimum trade-off between price stability and economic growth.
How do you think the USD is going to perform in coming years? There's been fair consolidation and not much opportunities in there.
Yeah, but that's a very difficult question and also a very open question. The fortunes of US dollar is beyond our comprehension, but I must tell you that there has been a lot of discussions on de-dollarization. That is a reduced importance for the US dollar in the global economy. But we do not believe that it is something that's possible immediately because of 2-3 factors. One factor is that 95% of the foreign exchange transactions on a daily basis is done in US dollars. 40% of trade, exports and imports is invoiced in US dollars. Then about 60% of the foreign exchange reserves of all major central banks in the world is in US dollar denominated assets. So the US dollar is a global currency, and it is demanded by central banks to invest their foreign exchange reserves, exporters and importers to invoice their currency, and traders and investors across the world on a daily basis. So US dollar strength in that sense is going to continue. But we may see variations in the exchange rate, especially at the marketplace. Exchange rates could vary. As I had mentioned earlier, what gives strength to the US dollars at this point of time is that the US dollar interest rates are rising. The market yields are higher. Official rates have moved up. That gives an advantage to US dollar because the currency yield is relatively much higher compared to other currencies. So it gives strength to the US dollar. Asset movements means investment decisions by international investors, which lead to asset movements from one currency to another, could also give some strength to the US dollars. But if interest rates start coming in, US dollar could start depreciating gradually. The last time around when the US dollar depreciated, the level of depreciation, the rate of depreciation was to the tune of about 30%. So we do not expect such a huge depreciation in the US dollars because there are other factors like US economic growth, which could revive over the next 4 to 6 quarters, could give an impetus to the US asset markets, especially equity markets, could lead to international investors crowding into the US markets and invest into the US equity markets. So that could give strength to the US dollars. But beyond these interest rate trajectory of rising interest rates, once it comes to a halt, it is highly likely that we could see the US dollars gradually depreciating. That is probably the most likely scenario. That's our view on US dollars.
Thank you, Dr. Joseph, for
Thank you very
sharing
much.
your views with our viewers.
Thanks a lot.
Thank you so much, viewers, for being with us on this episode today. Till we meet for the next one.